All right, ladies and gentlemen, guess who's back from his holiday? It is me, Tony, the head financial analyst at FinancialJuice, and of course with MACROACE as well. So, glad to be back. We've got a little bit to cover with the Bank of Canada, what the sentiment, and also what's happened and what the aftermath of Fed's Powell and how that's affected the Canadian dollar, and whether or not that could affect trading today, or how much it will affect trading today, or how much movement we could expect from the dollar CAD. But let's get into the Bank of Canada rate prep. Don't forget, if you are watching me live now, thank you very much for joining me. Don't forget to share the video, subscribe to the channel as well, get the word out there. If you've used me before, if you've had a look at my videos before, and if you found them useful. First of all, let's see how it affects the markets. Very simple with the currency. Whenever the interest rate is raised, the currency usually appreciates, unless it's already been priced in, that is. But if it's, let's say if the data or if the figure is higher than the expectation, so today, of course, the forecast is for no change and for the rate to remain unchanged at 4.5%. If for whatever reason Macklem decides to go with a hike today of, or with a 25 or even a 50, then of course higher than expected rate will lead to appreciation from the Canadian dollar. Of course, on the flip side, when you do get the rate decision, and even if it does come in as expected, then you're looking towards the statement that's released by the central bank to kind of gauge what the feeling is of the central bank and what could lie ahead for the Canadian economy, or whichever economy it is, whenever you get the statement. Now, for the stock market, again, very simple. Stocks don't like higher rates of interest or higher than expected rates of interest, and that will lead to a depreciation in the Canadian stock market. And what it could do sometimes, depending on what's said in the statement, or depending on what the rate decision is, that could also have a ripple effect on not only the Canadian dollar, but also on all Canadian stocks, but also other areas, other parts of the stock market. So it might influence the US stock market or other non-Canadian dollar currencies. Again, that depends on the severity or the magnitude of the shift in change of sentiment from the central bank, and what the expectation was and what the actual outcome was as well. But usually for the stock market, a higher rate of interest doesn't bode well for the stock market. Now, for the bond market, simple again, when interest rates rise, bond yields also rise as well in anticipation of higher rates of interest as well. But again, if the rate is priced in, then you probably won't get too much of a clear direction of a reaction, i.e. you'll see more whipsawing happening within the bond market. So bond yields will usually see an appreciation if you do get a rate that is higher than expected. If it comes in as expected, but the statement is very hawkish, okay, i.e. the central bank is looking to tighten monetary policy further, or maybe start hike interest rates again rather than pause in this scenario, then you'd see bond yields see an appreciation, or more of an appreciation than they would if the rates as expected, and you get a boring statement. So of course, bond prices, if bond yields go higher, bond prices go lower. The reason why that happens is to manage demand of those bonds. So if you don't know how, or if you're unsure of how bonds work, that's how it happens. If you put the bond yield higher, bond prices are lower. Usually there's two reasons. One of the first reasons is traders in the bond market are expecting a high rate of interest, or the government or the economy is doing quite well, and they can afford to increase the rate on the bond yield and give it at a cheaper rate as well. So that's how it affects the market. So hopefully you've got a basic understanding now. Or again, of course, feel free, of course, to watch the video back as a retrospectively to understand the sentiment of the release and how it could affect the markets. But that's how it usually affects markets. Now, where is the economy at the moment? So this is also very key as well. So first of all, inflation, the big top dog point that is affecting and still is having an effect on central banks around the world, mainly in the developed nations. But inflation in Canada is at 5.9% versus 6.3%. So it is going down. It's stickier than what it has been like compared to in the past, where you've seen bigger moves in inflation moving downwards. But that just means the central bank might have to do a bit more extra work if need be, if inflation continues to remain sticky or isn't really heading downward, it starts going back up. GDP data that we had in February as well, a quarter-on-quarter annualized rate for Q4 of 2022 was at 0% versus Q3 of 2.9%, which was much worse than our expected. Well, the forecast was, if I remember, if it was around 1.6%, and we had got 0%. So the Canadian dollar had weakened off the back of that data. Again, if the part of that reason being is that if the Canadian economy starts to falter and productivity falls off, that means that there is more of a chance of the central bank to step in and maybe try and ease monetary conditions to try and help productivity indirectly come back up again, and to try and support the economy that way, and then leave the rest of the work to the government. Employment change, again, with some blowout figures, we had 150k versus 104k. So again, that was another nice surprise from the Canadian economy, which led to a lot of strength from the Canadian dollar for the trading session when we had the figure that had come out for the employment change. The average hourly earnings, again, another key measure of wage price inflation, was at 5.2% versus the prior 5.4%. If inflation in the wages area is seen to be sticky or not coming down, or it starts to rise again, that means that the central bank's role is made a bit tougher to try and bring down inflation as best as they can. Unemployment rate was remained unchanged at 5%. Retail sales were spot 5% versus minus 0.1%. And PPI year on year was at 5.4% compared to 7.6%. And finally, the raw material price index at minus 0.1% versus the prior of minus 3.1%. So besides the employment data, everything else is showing moderation in the figures that we can see here from the Canadian economy. And more or less, if the employment change doesn't continue to throw out strong figures, then the Bank of Canada's choice to go with a no change makes more sense. So we're waiting for data this Friday, of course. It would be too late for this meeting today, but that could influence the Bank of Canada's decision for the next meeting when it does occur. Now, the previous Bank of Canada rate decision, January 25th, so what they said is that they're prepared to raise policy rates further if necessary to return inflation to the 2% target, and they'll continue quantitative tightening. Inflation is expected to fall to 3% by the middle of 2023 before returning to 2% target in 2024. They also said the 3-month measure of core inflation have fallen, indicating that core inflation has peaked. And inflation would average 6.8% in 2022, with 6.9% in October MPR, 3.6% in 2023 versus 4.1% and 2.3% in 2024 versus 2.2%. And saying that there is growing evidence that restrictive monetary policy is slowing activity, especially household spending. One of the other key things that I did note in the deviations, if you have access to that, is of course the reason why the Canadian dollar had seen weakening is that the Bank of Canada said that they're likely to hold rates at this level while they assess the impact of cumulative hikes. So this would be the first central bank or major central bank to hold rates. I was sticking at 4.5%. Now the Federal Reserve is way ahead with their tightening phase. Well, still in their tightening phase, and at a much higher rate, than where the Bank of Canada is at the moment. So, how does that impact the Canadian dollar? Well, we'll talk about that in a little bit. So, the Bank of Canada meeting minutes, the first time that they've released this, there was a request by the IMF to create or to provide meeting minutes, or a bit more detail as to what the Bank of Canada was thinking. Council debated whether to keep policy rate unchanged because it was beginning to work and simply needed more time. Then the council was concerned that tighter monetary policy would have a greater than expected impact on the housing market. Rates were raised on January 25th due to labour market tightness and stronger than expected third quarter GDP. So again, if GDP and employment is stronger than expected, of course, we're going to have to wait for the next round to happen. Then that makes it the Bank of Canada's job a little bit harder to bring down productivity. Bank of Canada views, Macklem said this is a conditional pause dependent on the economy developing broadly and in line with the forecast, and it is far too early to discuss interest rate cuts. This is something that a lot of commentators, traders have been thinking: when will central banks start cutting rates? And if they're not looking to start cutting rates until at least 2024, then that makes it that could mean that if the central bank might be holding for much longer than traders anticipate. Also, Macklem added that more hikes will be required if wage growth does not moderate in tandem with inflation expectations and pricing behavior does not normalize. Bank of Canada's Deputy Governor Boudry said that if inflation is over the target for an extended period of time, a high and fluctuating inflation will almost certainly be associated with a less efficient and more distorted economy, i.e. making it more difficult for the central bank to pinpoint where they should really focus on with their tightening monetary policy and whether or not to do another interest rate hike in the future. Sentiment of views as well. So you had February 6th, Bank of Canada fourth quarter market participant survey showed the median expectation of 4% of interest for the interest rate in by December 2023. i.e. they're looking for a rate cut this year as what market participants are looking at. BMO said they expect central banks to hold off cutting rates until 2024. The Bank of poll as well. You had traders, according to 32 economists, expecting the Bank of Canada to keep their overnight rate at 4.5%. Scotiabank said that the Bank of Canada is constrained in how far interest rate rises may lag behind those of the Federal Reserve, with the gap threatening to undermine its currency and fuel inflation. So remember, whenever you're raising your interest rate, you're also raising the value of your currency at the same time as well in the longer term. So if the Bank of Canada has stopped raising interest rates and is holding, their value will start to diminish compared to other central banks that are continuing to raise interest rates and maybe even past the point of where the Bank of Canada is, which makes their currencies more valuable to international investors and also anyone trading domestically within that nation. So that's one thing to be aware of, that if the central bank does stay with pausing their rates and other central banks are raising their rates, but inflation continues to go higher in Canada, then that makes the Canadian dollar worth less compared to other central banks that are taking action to bring down inflation or control it. Okay. Then March 7th, so yesterday, so the loonie hit a 4-month low post-Powell comments, and the expectations were rising for the Federal Reserve to hike by 50 basis points instead of a 25. it's somewhere around 70% chance of a 50 basis point hike happening at the upcoming or at the next meeting with the Federal Reserve. Again, that was off of the back of Powell's Powell basically saying that they'll that they need to do more work. In summary, to try and bring down inflation within the economy and make sure that the economy doesn't overheat. Considering how the job market was, with 500,000 jobs being added as well, that pressure of the jobs that are being added within the economy, that makes it harder to bring down productivity and then in turn bring down consumer spending and inflation. Other investment bank forecasts then, so simply put it, all of them are looking at the rate to remain unchanged. BMO, Scotiabank, TD, RBC, and also Goldman Sachs as well. Then if we look at the previous market reaction as to how it reacted, so if I kind of go here. So before I continue playing this, now what we can see is that the markets were already reacting to or moving before the release had even come out. So you can see that the Canadian dollar was already weakening beforehand, before that happened. So this is about less than 10 seconds before their release. Okay. So the rate came in as expected at 4.5%. Remember, it's the statement that comes through that led to the Canadian dollar further weakening. Okay, because they talked about holding their policy rate and seeing what the effects are of the economy and assessing those, and then making any further decisions. So this is what so the market reaction wasn't that big as what we've seen in the past. Okay, so if we kind of skip through, we'll kind of see where we end up. Okay, so again, the Canadian dollar continued to weaken off that data. But remember, it's not just the data, it's also the statement as well that accompanied it. Okay, that can either make or break a trade, or make or break whether you can jump onto, whether you can find that leg of volatility that comes through. Okay, if market participants, if traders are expecting the central bank to be, to hold rates, but then the statement is more hawkish or more dovish than expected, then that's something to be aware of, and whether that creates extra volatility. And what we've seen here is that you didn't really, the movement had already happened beforehand, before the rate had come out. So there wasn't that much room left for the markets to kind of move, but you still had a decent bit of move anyways when the rate did come out, and they did confirm that they were going to pause rates. Okay, so that was the last rate decision. Now, if we look at the deviations as well, let's bring that up here. All right, here we go. So this is what we've seen last time. So if you're not sure with what I'm talking about when I say deviations, I'm just showing you how the markets reacted to what happened. Okay, so I've got the sentiment here. But usually I provide the sentiment of what the headline was, or what was said that caused the market to react in a certain way for interest rate decisions, for scheduled economic releases like non-farm payrolls, or or let's say CPI print. Then writing down sentiment is a bit different. But if we can see here that when the rate came in as expected, okay, it was a statement. It was part of the statement that rocked or led to the Canadian dollar weakening. So the biggest move that had occurred, and we've seen consistently, is from GBP CAD in the past. So here we had seen about 53 pips towards the upside last time round, 77 pips down. And then in the past, when there has been a surprise with the figure, where there's been a smaller rate increase, or maybe there's been a higher than expected rate increase, you've seen a bigger market reaction. But still, GBP CAD has seen the biggest market reaction in the past. And then you follow that up by looking at the EuroCAD and then dollar CAD, CAD JPY. Okay, so that's what we see at the moment with the rate decision. All right, so not only did we get the Canadian data, but we also get JOLTS data too. So it's more or less could, depending on what JOLTS data does, that could also, if the S&P starts moving, that's not off of the Bank of Canada. That most likely be off the JOLTS data, more US focused. But yeah, here we go, as seen. So that's what we've seen here in the past with the Canadian data. Now, let me make this clear again as to what to expect and what to kind of be prepared for. If you want me to kind of give you a quick rundown, if the rate comes in line with expectation, okay, you would be looking to the statement that is put out. If it's hawkish, i.e. the central bank is looking to, if they do decide to raise rates, if they do decide that they want to raise rates in the future, okay, rather than saying we will wait and see and assess the situation, they do say they want to raise rates in the future because of maybe employment, the labor situation in Canada, or maybe inflation seems to be stickier than they would have thought it would be, then that could lead to Canadian dollar strengthening. But if you have the flip side, on the dovish side, where they say that inflation is heading down, the labor situation isn't really going to have that much of an effect on their monetary policy stance, and they can kind of leave rates where they are at 4.5%, then that could lead to the opposite effect, where you'd see Canadian dollar weakening instead. But surprise, again, if we do get a 25 base point hike today, when the central bank has already said that they'll look to hold rates, that would be a very big surprise. It will be the opposite of what they said. And then the central bank will lose its credibility, because then you don't know what they're going to do. And they'll be even less predictable than they have been already. Or yes, they are. It's hard to understand. It's hard to kind of gauge which route central bank might go for definite, but you guys get what I mean. All right. So, anything higher or lower than expected, expect more volatility from the market. If it does come in as expected, look to the statement and see what is coming through. See what comes through, and we'll kind of gauge how the markets react to that. So I'll also try and go through it with you guys as well, myself, the statement. Okay, so that is the deviations then. So deviations, how do you get access to the deviations? Well, all you got to do is subscribe to the MACROACE mailing list. Okay, so not only do I have the Bank of Canada rate decision here and how the market's reacted to that, we've also got the rate decision for the FMC. We've also got the ECB rate decision as well, and also non-farm payrolls and so on. Okay, depending on what moves the markets the most, that's what we kind of focus on at MACROACE. So not only do you get the deviations completely for free, okay, but you also get access to a summary of what to expect for the week ahead in the different sessions in Asia, US, and the European session, and a summary of the weekend news. Now, of course, I was away for the past couple of weeks, so of course, I did miss the consumer spending for the US alongside the personal consumption expenditure index, or PC price index data. But that there is how you can sign up for the MACROACE mailing list. Again, completely free. It's not filled with big old charts or figures. It just has a link to the deviations, the upcoming live streams for the week ahead, and a bit of a summary of what to expect in the different sessions. Okay, the money is here with talking to me, is where I kind of talk to you guys and explain in detail of what to kind of expect for the upcoming economic release. Right, so that's the deviations there. FinancialJuice is where we're going to get the data from. We're going to see that in live as well. And then also, remember, FinancialJuice, a live voice and text service, is something that only the big boy traders, really have access to. So if they use that to manage their trades or manage their risk that they have, or capitalize on potential trades. If you're a day trader, knowing what's going on in the day and why the markets are moving is a big advantage compared to if you're just looking at the charts and taking the charts as they are, which you can do. That's perfectly fine. But why not understand why the markets are moving and then, see where you go from there? You could, in fact, be able to make a better informed decision with your trade, depending on what kind of news comes out. Let's say Macklem says something crazy. So let's say the statement says something crazy from the Bank of Canada, and you see the Canadian dollar flying, but the rate is as expected. You don't know why, but that's what a live voice and text service is there for. Just kind of break down that important stuff for you. So here you can see on the site here. So you've got your live voice here, and you've got your news feed with your text headlines coming through as well. We also, if there is something that does move the markets or has moved the markets, then that's also shown there as well. I've pinned that link in the chat there for you too. But again, don't forget to so also with our news feed, you also have access. You can also see the economic calendar here for all the different economic releases as well. You can stay informed and see everything all in one place. And the need to know, okay? So the need to know market risks just informs you of what are the risks that could be associated for the trading session ahead, or the risks, or maybe there's a bit of news that has already come out and has already moved the markets. Okay, that's what the need to know market risk is there for, just to make you aware of what are the risks, or the risks that have already occurred within the trading session. Thank you very much, World Shirts. All right, so about 3 minutes left. A couple other things as well. Again, so if you do want to, jump onto the FinancialJuice news feed. If you don't have an account already, make one first. If you want to pay for the pro version straight away without using the live version. Again, the live version, of course, is free. But if you want to go for the pro version straight away, first you need to have an account. Okay, have your login, verify your account via your email, and then come back to the FinancialJuice site and pay for your plan that you want to pay for. And then once you've done that, then log out, then log back in. That acts as like another verification point. Once you've logged back in, then you should see the site like this, okay? With a sign looking like this, where it says FinancialJuice Pro rather than saying Go Pro. Okay, the color you can kind of change and do whatever you want with it. So that shouldn't, but the key thing is you want to see that logo there. Again, that's totally up to you. The link is in the chat to go to the website. If you haven't already got an account, totally up to you. Do what you want with it. You can go pro, or you can even use the live version, and that's still very useful too. But don't forget to get the word out here about the MACROACE live event of me going through the Bank of Canada with you here. All right, we've got about 2 minutes left. 2 minutes to the top of the hour. Again, as said, the rate decision from the Bank of Canada. Again, rate is expected to remain unchanged, and we also get jolts too at the same time. Okay. All right. Let's see what we get. 1 minute now. Less than a minute. Okay. We've also got to get TICKSTRIKE up and running as well. Should be able to get it pretty quickly. Canada. Okay, swapping around. Okay, so we've got dollar CAD, GP CAD here, Euro CAD and CAD JPY. Okay, 10 seconds left. Okay, no change as expected. So no change at 4.5% as expected. Got jolts coming in through as well at 10.84 million, 10.84 million, higher than forecast of 10.5455 million. Okay, all right. So let's look at the statement two. So also looking at the market reaction. So dollar CAD seeing more of the market reaction. Now remember I said the loonie hitting a 4-month low, that's seeming to have the bigger impact compared to the other currencies here as well. So again, Canadian dollar seeing some weakness here off of the back of this data. Now the statement, let's have a look through here too, see what's being said. Weak economic growth over the next couple of quarters means pressures in product and labor markets are expected to ease. Okay, that's one key point. Productivity expected to decrease. What else have we got here? What else do we have? They repeat that it expects to hold key rate at its current level, conditional on the economy developing broadly in line with its forecast. Latest economic data remains in line with the bank's expectation that overall inflation will come down 3% in the middle of this year. Restrictive monetary policy continues to weigh on household spending. Yeah, other than that, there isn't really anything surprising out of that. Now, let's compare. So the dollar CAD has seen the biggest market reaction. If you're just joining me now, I did talk about how Powell had rocked the market yesterday and caused the sell-off in the S&P and a rise in the Dixie because traders were pricing in a 50 basis point hike because traders were starting to price in the expectation of a 50 basis point hike more so than a 25 at about 70% now on the CME Fed Watch tool. So that would be the only reason why the dollar CAD has seen a bigger market reaction compared to some of the other currency pairs that we can see here. Let's do a quick measure. Let's see how many pips we see. Okay, so again, Canadian. To be honest, it's not that much. So more or less a boring statement. So 28 pips towards the upside. So again, Canadian dollar weakening, but to be honest, doesn't really care. Yeah, it's more or less a dud. Okay. All right. Yeah, that's dead. That's 5.5 pips towards the downside. CAD JPY. So again, okay, the rate came in as expected. The dollar CAD reacted more so compared to its other counterparts, and still it's provided a cleaner move compared to what we're seeing on GP CAD and CAD JPY. But overall, I said a dud statement, and the rate came in as expected. So not a lot has happened. I have to summarize that right there. The TICKSTRIKE. So remember TICKSTRIKE. So if you're unsure or unfamiliar with what TICKSTRIKE is, TICKSTRIKE basically allows you to listen to order flow within the markets. This here, okay? This is what TICKSTRIKE is. So in another way, it lets you listen to how strong the buying or selling momentum is within the different assets, whether it be in Forex, the stock market, whether in stocks, futures, crypto as well, your internals. So if we're talking about the VIX as well, it will also measure that too. But that's what TICKSTRIKE is there for. So again, if you're a day trader, right, or if you like to scalp the markets, again, another tool to add to your arsenal in your trading day as well. There's also So let me explain these numbers here if you're unsure what this means. So +2 or minus figure or plus figure. A minus figure shows that there's selling momentum, and a plus figure buying momentum. Now the numbers on this slider here, number 1 is the most sensitive to market reactions. So as you can see here, there's a little bit of buying momentum going on, and then TICKSTRIKE kind of pops off, okay, and gives you an audio or visual alert, or both, depending on what you want to do. If you increase that level or move that slider, keep moving it up to all the way to level 15, level 15 is the least sensitive to market reactions. Only when there's a big amount of buying or selling momentum that matches up with what TICKSTRIKE's parameters, then only then will TICKSTRIKE go off and give you a visual and audio alert, or either or, whichever one you want. So that's what we have here for TICKSTRIKE. Again, there is a if you've seen my videos before, I'm going to put in a link for a 7-day free trial that we have of TICKSTRIKE. Again, if it's for you, have a little play with it, see what kind of works for you, if it doesn't or does work. But that's there for you in the chat on the YouTube stream. And then finally, unusual activity. Okay, the new so if you like to trade unusual volume activity in stocks, then you can join and become part of the service. Okay, and you can have a little play of it as well. So if it's not only in stocks but also in crypto, forex as well, and futures, you can also have a play with unusual activity as well. All right, well, that is it. So what are the next videos? What do we have coming up this week? Friday is the big day, the big date. It is non-farm payrolls, okay, which then coincides with Canadian employment data. So we have we're gonna have a busy Friday morning, but I'm gonna link you to that video so you don't have to. If you're watching the video now, then I'll link you to that video as well here. It comes up. Here we go. All right. Oh yeah, so that's the next stream that we have, okay, for non-farm payrolls and the Canadian employment change. All right, ladies and gents, thank you very much for joining me live. Don't forget to share the video, subscribe to the channel, get the word out there to your family, your friends, your pet dog. I don't care. I kid. If you genuinely found the information useful, then subscribe to the channel, get the word out there, share the video too, and I will see you Friday. All right, thank you very much, people. Take care. Goodbye.